Afternoon, everyone. Thank you so much for joining us today. My name is Maria Asher, and I'm a co-portfolio manager in Westwood Select Equity and Dividend Select Strategies. Today, we wanted to take this opportunity to talk about what's been going on in the markets, where do we think the markets are heading, the concerns around debt ceiling. For that, we have a perfect panel to discuss all your questions. We have Leah Bennett, who's the president of Westwood Wealth Management and is the lead PM on Westwood Select Equity and Dividend Select Strategy. We also have Adrian, who is the Director of Multi-Assets and our CIO here at Westwood. Hi, Leah and Adrian. How are you doing?
Good, thank you.
Doing good. Thank you, Maria.
Thank you so much for joining me. And let's start with the first question. Adrian, it's for you. Obviously, last year was a difficult year for all asset classes. This year has started on a better foot, but a lot has happened this year as well. So, can you please, for our listeners, recap what has happened so far for the year?
Sure, of course, yes. Last year was a difficult year. This year, realized inflation has come down pretty sharply. So that realized inflation, meaning that contemporaneous inflation that we're experiencing, depending on the specific measures of inflation, I'd say it's still elevated at around 5+%. That's a big deal. The official target is around 2% inflation. So a lot of wood to chop for the Fed there. And inflation data and indicators that we're seeing and we're watching are kind of a mixed bag. The inflation expectations. So if you think about the Treasury inflation protected securities market, gives us an idea of what's expected. In 2 years, it's currently at 2%. So that has come down sharply this year. The market is telling us that actually maybe the back of inflation has been broken. The market has a strong expectation that the Fed and/or a demand destruction market is going to break the back of inflation itself, and we're going to see rates stop going up, if not even come down. So part of a result of that is that we're seeing interest rates rise and fall over the course of the year. Over the first quarter, interest rates fell pretty significantly. Risk-free rates were down almost 0.5% over the first quarter, and not far off. They've come back a little bit, but not far off of that now, effectively reflecting that expectation that the Fed is going to stop hiking interest rates. In equities, the NASDAQ did extraordinarily well. It entered a bull market from the end of the year out till the end of the first quarter. That means it rose 20% from its base. The S&P 500 is up 7.5% as of today. Markets are, of course, moving today, so maybe that has even moved by the time I'm speaking. That's a big difference to the NASDAQ. And that's probably one of the biggest stories of the year to reflect on, the outperformance of technology and growth orientation relative to value orientation and other areas like energy and financials. The tech names in the S&P 500 are up 24% this year. Consider that relative to energy and financials, no surprise, but energy is down around 11%. Financials are down around 6%. That's pretty substantial. Digging in a little bit further on that, it's largely driven by the largest growth names. So you think Apple, Microsoft, NVIDIA, Facebook, now Meta, and Amazon, with a close sixth there being Google as well. So these large names that are contributing to growth, just those 5 top names were 75% of the return of the S&P 500. So that's where we're seeing it. We can start to talk about what's ascribed to that, whether it's artificial intelligence or new margins or simply a move towards large growthier names with interest rates falling, but it's notable. Other areas of note are oil prices have come down, as have copper prices. We believe this is reflective somewhat of a lower potential growth environment. And these are the usual signals that we get from that. Gold is up somewhat significantly. Maybe signaling a little bit higher systematic risk as we go to a lower growth environment and a persistence of the inflation that we've seen. International markets have outperformed U.S. markets to date, but we could see that reversing in the future. And as always, things are moving as we speak.
Yeah, and Adrian, I think you highlight a really important point. I've talked to quite a few people, and they seem to think we're in a bit of a trading range. But if you look deeper underneath the indices, you can really see these very violent rotations that have been occurring. And we've really been talking about those as a firm from an asset allocation perspective, as well as within the investment strategies. And so in a lot of our asset allocation models, we started allocating more towards growth as our projections that we were closer to a point where interest rates were starting to peak. And that has paid off nicely. We've gotten more optimistic about emerging markets. So there's definitely been changes going on from an asset allocation perspective, as well as within the investment strategies themselves. The PMs have certainly, the portfolio managers have been making lots of changes based on our projections and trying to capitalize on these rotations that we're getting in the market. It's actually a great market for active management right now.
Thank you so much. Thank you, Leah and Adrian. And I think another thing that we need to talk about what happened during the first quarter was the regional banking crisis. So what kind of contagion do you think it will have, if any? And more importantly, do you think it's having an impact on credit cycle or credit markets overall? Adrian?
Yeah, good question. And those are two distinct things that are the impact. I'll go back and say that, thinking about contagion, this is a product of the Fed hiking interest rates pretty dramatically over the course of 12 to 14 months. A monetary policy tightening cycle often takes somewhere around 12 to 14 months of lagged effect to materialize its effect on the economy. What have we seen so far? We've seen in the United Kingdom, they had a bit of what's called an LDI crisis. They had a crisis with some of their investments as well that was driven by rates going up, because we're not the only ones. We saw crypto, of course, experience somewhat of a crash. That was related to valuation on assets and various other things, I think related to rates going up. Now we're seeing it maybe more concerningly in the banks that we hold so dear, because these are the credit engine of the economy. These help companies finance their growth. You hit it directly on the head of the two big impacts. When you think about credit tightening, I'll take that one first. Definitely. We are seeing that before already the mid-March failure of Silicon Valley. So this is not necessarily a product of the concern around that bank failure. This is a concern around banks already recognizing that we're going to experience a slower growth environment. Recent data from the Fed and other surveys are showing that is increasing and has increased more even after what happened in mid-March. That's not a credit crunch like we talked about in the global financial crisis, but it's harder to get a loan if you're a small and medium-sized business than it was in the past. It used to be that, of course, you show up at your small bank and you say, well, here's my past 4 quarters of earnings, and here's 20 pages of documentation, and that was fine. Effectively, now they're saying, we kind of want to speak to your mom as well. It's harder to get a loan. I say in jest, you show a whole lot more paperwork. The needs are much more from the bank of actually giving you a loan because they're concerned about you repaying that loan. The impacts of that are certainly less economic growth potential. Credit is an absolute engine of the economy. And so without that impulse, there is less potential growth. That's concerning, and we can model that out. It's not, as I say, a credit crunch, but it's something we're keeping an eye on. We're already expecting a lower than average growth environment. Usually we say trend growth, real economic GDP growth at 2%. Right now, 2023 is expected to be around 1%. So it could constrain that further in the near term as we see that. The second piece of that is companies that need to refinance their near-term debt obligations. So you've borrowed before 3 years ago, and that's becoming due to finance a project. You need to go back to your bank and say, do you mind if I borrow again and refinance that obligation? And now they're saying, we've got something else to do. We're not going to be able to do that. We're going to see more of that. So we're going to see more small companies that will default as a result of this. It's, that's difficult, but we can get through that. And much of that is priced in the market already, that we're going to see a higher potential default environment. Those are the impacts of the credit tightening. The contagion, I'd say less so at this point. What we will see is and we talk about contagion from those bank defaults, those 2 bank defaults, really 3 that we saw in mid-March. I think that we've seen much of the impact of that. We're going to see, I don't call it contagion so much as the delayed impact of the monetary policy aggression. And we're going to see small regional banks that aren't going to make it through this. They're going to have the FDIC show up at their doorstep on a Friday afternoon and say, we need you to stick around for the weekend so we can go through your books and reopen you with safety and give your depositors their money back on Monday morning. we'll see more of that. And just as an example, what we saw in the global financial crisis was in 2008, we had two big banks default, most notably lending banks. Those were Washington Mutual and IndyMac. And we had some other defaults, but they were small ones. Then fast forward to 2009 and 2010, we had over 100 banks default in each of those years. And most of these are banks you've never heard of. They're very small banks. I think we will see more of that. I don't call that contagion so much. Now, there's 4,500 banks that are regulated in the United States by the FDIC. So clearing some of those up that have been not operating as well in a higher rate environment may not be so bad. It's the larger banks that we would be concerned about if we saw more of that.
Thank you. That makes a lot of sense. And Leah, my question for you is obviously, when the regional banking crisis started in March, we saw a lot of banks come under pressure and they started over 2-3 days, stocks values fell more than 50, 60, 70%. Obviously, it is painful, but generally when there's periods of pain, it also creates a lot of buying opportunities. So are you seeing some buying opportunities for our clients in this environment?
Yeah, I definitely think a strength of Westwood has been whenever we see dislocations in the market, we try to be very opportunistic for our clients. So if I go back and think about like March of 2020, when the COVID crisis first began, the debt markets became dislocated. We started a strategy called Credit Opportunity, and then another strategy called High Alpha, which was looking to maximize on opportunities in the markets, which was an equity strategy. And we've seen kind of two things through this regional bank crisis. One, we did put together a regional bank strategy that we launched at, I think it was the very end of March. And I want to talk a little bit about kind of how we found opportunities in the space. But also something that was really interesting is all the investment strategies managed by Westwood were actually underweight the regional banks overall going into the Silicon Bank failure, which was impressive. And then when Monday happened, after Silicon Valley and Signature were both taken by the FDIC, nearly all of our investment strategies started purchasing regional banks that we thought were very well run, well capitalized, and had good management. We could pick them up at really significant discounts. And so all the strategies have basically been purchasing them. And then in addition, we've started this regional bank fund. Back to the point that Adrian was making, it has been really interesting. If you go back to why this crisis has happened and why it's probably not a systemic issue, anytime you have an environment where interest rates are exceptionally low, it always induces some level of risky behavior or incentivizes taking on risk. So if you think back when in 2020, when interest rates were so low, if I am a bank and I have a savings account, in a period like that, it's really difficult to pay anything. So if you remember, savings accounts were paying 10 basis points, 1/4% at the most. And in order to make that return, banks were really incentivized to go out and invest in 10-year, 30-year bonds. And that's part of the reason that created or was the foundation for creating some of this crisis. And then on top of that, you had a lot of banks that made really poor decisions about not making sure their deposit base was fully diversified. And we saw that with really Silicon Valley Bank, where 91% of their deposits were uninsured, and they were so highly exposed to venture capital. When you have these concerns about the health of a bank, it becomes very easy to have these bank runs. We do not think that's a systemic issue. And you've got banks that are well capitalized, that are much more diversified in terms of their deposit base. And that's why we don't think this is part of the reason we don't think this is a systemic issue. And there are really some really compelling buys out there. So we like the space quite a bit. And that's the fun part, I think, about investing and trying to add value to our clients.
Thank you. Yeah, I totally agree with you. Periods of distress actually create an opportunity to create alpha for our clients. So let's shift our focus to something that I think a lot of our clients are concerned about, and it is debt ceiling. So if you look at, obviously the deadline right now is June 1st. If history is our guide, we'll probably, get some kind of an agreement and the debt ceiling will be raised. But I just wanted to hear your thoughts about what do you think is the likelihood of that happening, and worse, if is there a chance that the debt ceiling will not be raised? Adrian?
Great. Well, I always begin this with, I'm not a politician, and it's a very political game that's being played. The possibility that it's not raised on time, I'd say maybe higher than was expected at current. That doesn't mean that we will default on our obligations, but not raised on time as far as hitting an X date. We'll start preferencing things. I'll go back and just say Congress has always acted when called upon to raise the debt ceiling. Since 1960, we've raised the debt ceiling. Congress has raised the debt ceiling 78 times to either permanently raise it, to temporarily extend it, or to revise the definition even of the debt ceiling. It kind of feels like Groundhog Day to me, as I've been in the market for a long time, as have Leah. I literally keep a bunch of notes on the debt ceiling mechanics and the market impacts. And each time we have this debate now since 2011, which is where it became really polarized, I revisit those notes. The parallels this time are with 2011, and the concern is more elevated than it's been since what we call the debt ceiling crisis of 2011, when the debate led to the passage of the Budget Control Act of 2011, which was a fiscal austerity bill. Now, recall at that time, Congress agreed to raise the debt ceiling 2 days before we got to the point where the Treasury would be unable to extend their borrowing authority, in which case the U.S. would be unable to meet the repayments of its debt. That was a very concerning level, after which the Standard & Poor's rating agency downgraded our U.S. Treasury debt from AAA down to AA. Interest rates dropped dramatically after that happened. You might expect for a riskier lender, which is what the rating agency was saying the United States is, interest rates would go up. You charge more to a riskier lender because you might not get your money back. Not so in the risk-free world. Interest rates dropped pretty dramatically after that. The equity markets dropped substantially after the debt limit was achieved as well. Why is that? That is because the fiscal austerity piece of this, and that's what we're now going down. And so that's where myself with my investment hat on, I can start to prognosticate what's going to be the fiscal impact of this, and what's going to be the economic impact of that fiscal austerity that is likely. Because the likelihood to me right now is that we are going to achieve, we are going to reach the debt ceiling, and we're going to extend it, or we're going to renegotiate it. And as part of that, we're going to have some fiscal austerity that's introduced that brings down ideally our future spending. But that also means that there's a future spending aspect to growth. From the Budget Act of 2011, when we enacted that, government spending was a drag on real GDP growth for 15 straight quarters, which meant that we saw lower economic growth. So after it gets passed, we'll see the political wrangling that will come into that. Then we'll start to evaluate the devil in the details of how much drag on economic growth we'll see, and how much of that is actually priced into markets. What I do believe right now is we will see some elevated volatility. As I say, things are moving right now, and as we speak, there are negotiations that are happening that maybe lead to the end of this week, us having a raising of the debt ceiling that comes with fiscal austerity. That's a possibility. June 1st was mentioned as a possible X date. There are things that we can do to extend that out. I don't know as a non-politician where we get to on this, but I do think that it's going to lead to a reduced government spending impulse, and then it's up to us then to evaluate, what does that mean for markets? What does that mean for the expectation of future growth? This is what we're doing as investors. We're keeping an eye on, well, number one, if we see that, as you very much rightly mentioned, especially with the banks, there's going to be the haves and the have-nots. There's going to be the babies thrown out with the bathwater. Whatever paradigm we talk about there, we look at fundamental characteristics and we evaluate those. And if there are opportunities that we can uncover because we see volatility related to a debt ceiling crisis that we can invest in, that will be an opportunity that we can quickly rotate and invest in. And those are the things that we will look out for. Secondarily, of course, we'll dig into the details on whatever gets negotiated from both sides. they're extracting their political concessions, and they are likely going to find a way to reduce government spending. Not the worst thing in the long term, but it may actually lead to some short and intermediate term drop in economic growth. And we'll want to see where that is the most impactful. I don't even want to say the worst, because markets are already pricing some of these things in. So that's what we'll be doing as an investment paradigm. Whether or not we hit that limit and go beyond it and default on our debt, that's going to be a very difficult political question to ask. Us as investors are going to look to uncover opportunities when we see that volatility associated.
Yeah, and I think Adrian gave a really good a recap. Yeah, and it's a very fluid topic. I know last night they expanded the group that was negotiating, and so we seem to be inching towards a compromise. And I know even today there's been several comments that have come out that the debate's not about whether or not we're going to default. It's in the spending part. And that's what, when I think about topics like this, I try to think that people, especially when we're thinking about politicians, that usually people are self-serving. And when it comes to a politician, you probably don't want to be the person who was responsible for the default and not coming to a compromise. It becomes very difficult to get reelected. So I think that's part of the check of why something there'll probably ultimately be a compromise. It'd be nice to say that we always do the right thing, but that's not always necessarily the case. So I agree. And then when we're trying to solve issues and trying to manage portfolios, I really think you've got to consider the low probability events, but you've really got to think about those 90% probabilities. And that 90% probability is what Adrian kind of mentioned of, we're probably going to be in an environment where maybe there's reduced spending, which would be great. The deficit comes down, and then you've got to take into account what the Fed is doing, and we're moving more towards a recessionary type of environment. So those black swan events are some things that you've got to really think about from a risk perspective, but it's that 90% probability that you really want to construct your portfolios around.
Thank you. And I think it makes sense. And thank you for really shifting our focus from the debt ceiling to the consequences of it and the austerity measures that will be taken. So that makes a lot of sense. So let's go back to something that Adrian, you mentioned earlier, where you talked about inflation. Obviously, we have seen inflation ease up. It's probably not has come down as much as Fed or any of us would have hoped for, but it is improving. So keeping last week's inflation data, do you think that Fed is over the interest rate hike cycle, or do you think there could be more rate hikes going forward?
It is, or as of now, I think it's more likely that the Fed is going to allow a pause and evaluation phase. That means they're going to stop hiking rates in the June cycle and see what starts making its way through the system. See if inflation starts coming down, see if unemployment starts rising, seeing if constraints on credit because of what's happened in the banking system are causing more consternation. As I said, we're just hitting that moment where we talk about monetary policy as having a 12 to 14 month lag. Well, guess what? We hiked the first time in the cycle in March of 2022. So we're right about that moment. I think the Fed would be wise to see what is making its way through the system, because inflation is coming down. It's just not at that level now where the Fed is going to appreciate it. You talk about jobs, and jobs are certainly, or unemployment is certainly something that is extraordinarily low right now, and unexpectedly low, I'd say, for an environment where we're saying, oh my gosh, so there's the lower potential growth rate. There's the potential of us having a recession that's elevated over the next 12 months. And yet we're at a 3.4% unemployment rate, which is below the Fed's, what they would call maximum employment. Let's just do a Gedanken experiment. Me as an old physicist, think about these thought experiments. Let's suppose we're still at 3.4% unemployment in the next 6 months, i.e. unemployment is still very low, but inflation has dropped from 5% down to 2.5%, the Fed's mandate being 2%, so low enough to be within striking distance. Whether it's dropping from demand destruction or lower wage inflation, companies are unwilling to lay off employees too quickly for fear of having to rehire those employees to build capacity, i.e. they are labor hoarding I think that's a bit of what we're seeing now is even with lower environment, they are unwilling to lay off those employees quickly. Suddenly you're experiencing a collapse in credit availability that leads to potential defaults for small companies. The S&P is down 15%. The house value that you live in is down 10%. All of these things are pieces of your wealth. This is just a thought experiment of what might happen. As a Fed governor, at that point, you're probably saying, oh my gosh, unemployment is down at 3.4%, but inflation is down, and there's a concern on credit and financial conditions for the market. We are too tight on conditions. We're going to have to become more accommodative, and so you drop rates. That's what the Fed is going through right now. They're doing these kinds of thought experiments of saying unemployment is the one piece we look at that we're trying to push on because we actually need wage inflation to come down, because wage inflation is making its way into goods inflation, which is core inflation. If they can navigate a path of having reduced job openings, there's less demand for inflation, yet companies aren't necessarily firing people. People aren't having to lose their jobs and their livelihoods. Gosh, that would be a rosy scenario for them. And that's a bit of what they're trying to navigate. And they're doing right now, it looks like an okay job. Openings have started to come down. There's a survey we look at that's job openings and labor turnover survey called the JOLTS survey. The Fed uses this as well, has come down pretty sharply. Yet unemployment is remaining pretty low, 3.4%. The Fed's long-term expectation or next year expectation is for 4.6%. So that's in the millions of jobs range. They don't want those to be lost. They just want inflation to come down. Can we navigate that? That's the path that we're trying to go down. And I think it starts with job openings.
Yeah, and to kind of to continue on with Adrian's thought, it is labor that has really been the big issue if you're thinking about inflation. And I was actually looking through the Small Business Optimism Index, which was released in early May, and it's at the lowest reading it's been at since 2013. And the big issue is finding the right people. People are really challenged for those open positions. And as Adrian mentioned, there has been a little bit of relief, but still like 45% of respondents are still reporting some sort of issue. And again, this is with smaller companies. But on the other hand, if you look at the percentage of owners that are looking to raise their average selling price, those numbers are coming down. So I think it decreased by about 4%, down to the lowest level since March of 2021. And planned price hikes decreased by 5 percentage points to 21%, which is the lowest reading since November of 2020. And I think that a lot of that is because the input prices are finally coming down because of supply chain issues being finally relieved. Some of the global issues that we've had, we are starting to see the circumstances conditions a little bit better than what they have been. But the big challenge has been the demand side. And as Adrian mentioned, it's really been on the labor side. So sticky inflation.
Yeah, sticky inflation. And I think we are coming towards the end of our call, but I just want to ask one last question. At the end of the day, what our clients want to know is recession coming, or is soft lending where, we bring the inflation down without having to put the economy into a recession? Is that still a likely scenario? So just, quick thoughts on those, please.
Very quick. It's hard to bet against the US economy. There is a control valve, and that control valve is, well, in part, the US Federal Reserve being more accommodative when they start to see the economy not doing so well. So if they see unemployment start rising and economic growth falling dramatically, they will react and help the US economy. That said, we're in a lower growth environment. Recession is just an R word that just means below zero. The key here is that we're going to be in a lower growth environment. Will we experience a dramatic recession? I don't think so. I think we have a control valve. I think that there should be more optimism in certain areas of the economy. We'll see transition. We'll see elevated margins that will allow companies to make their way through. And we've had elevated savings rates, which mean the consumer is in a much better shape than in the past to keep doing what is 70% of our economy, which is consumption. So while I think there is an elevated probability of an R word of 2 quarters of negative GDP growth, the key here is less that than if we experience that, I believe it to be shallow and not super long lived. We're going to experience lower than trend growth for some period of time. That's key. We're going to find opportunities on the same token of those things that are the proverbial babies thrown out with the bathwater, the financials, the regionals that are going to have an opportunity to lend into new growth where they find its way happening, to find things like technology that are going to be able to elevate margins across the space. And so there is some exuberance to be found. We're going to experience lower growth just as a result of constraints from monetary policy.
Yeah, and just as kind of a final thought, I mean, it's what so if you think about, I think oftentimes people confuse a recession and an economic crisis, and I think us going into a slowdown makes sense. It's what the Fed is trying to do. That doesn't mean this has to be an environment where the market sells off significantly or goes back to new lows, or that it's a crisis necessarily. And Adrian mentioned earlier that credit is the health of the economy, and that is so true. And even if you look at consumer makes up a large percentage of our GDP growth, and if you look at the health of the consumer, we were talking about the housing market earlier, or the median credit score for mortgages right now is 765, which is very high. So we don't have like the same type of scenario that we had going on in 2008, where we were giving mortgages to everyone. And even if you look at consumer delinquency rates, they've been flat and they're around 2.6%. And to compare, if you look at the fourth quarter of 2019, they were 2.1 percentage points higher. So the consumer is in much better shape than what it was. And then in 2020, you basically had corporations really raising a lot of debt at a time where interest rates were close to zero. So you have lots of large companies that have really, really strong balance sheets. So I think we're in a different situation. And personally, I don't think it's likely that we're going to have an economic crisis, but having a slowdown and having a shallow recession is not I think in our capital markets outlook, it's about 50% chance.
Yep.
Thank you. Thank you so much, Leah and Adrian, for your insights. And these are all the questions I had. Thank you, everybody, for joining us. We hope you have a wonderful rest of the day. And please feel free to reach out to your advisor if you have any questions. Thank you. Bye-bye.
Thank you.
Thank you.